Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Mark Willis. Thanks for being on the show again, Mark.
My pleasure, Whitney. Thanks so much for having me on the show.
Mark is a certified financial planner, a two-time #1 best-selling author, and the owner of Lake Growth Financial Services, a financial firm in Chicago, Illinois. Over the years, he has helped hundreds of his clients take back control of their financial future and build their businesses with proven tax-efficient financial solutions. He specializes in building custom-tailored financial strategies that are unknown to typical stock jockeys, attorneys, or other financial gurus. So, thank you again, Mark, for being back on the show. I know right now with everything that's happening, it's just on the forefront. Everybody's thinking about, the best places to put their money. Should we be investing right now? Should we be just more liquid? What's going to happen, right, in the next 6 months to a year? No one really knows, but we're trying to make the best decisions that we possibly can, especially financially, and it's just hard to plan for the unknown. Right. And so, I think you have some unique methods that you're helping lots of people with. And I want to just get into that today, and just where cash should be right now. And you mentioned earlier before we started recording, just how to be financially immune to pandemics and while everybody else is really going crazy financially, or you called it a financial flu. I thought that was interesting. So, let's just jump in and let's just talk about this method, talk about how that could apply to an operator in the syndication business versus maybe, a passive investor as well.
Well, you're exactly right, Whitney. There's been a massive fundamental shift under our feet. I mean, who could have thought back on Valentine's Day that we'd all be wearing masks as we go back to school this fall? I mean, that's an unbelievable shift in our culture as an American culture and as a worldwide culture. But I'd like to tell you guys a very quick story. I was walking through, I remember back in mid-March actually, walking through the grocery store and just seeing the empty shelves and people walking with 100 different wine bottles in one grocery cart and 200 toilet paper rolls in a following shopping cart. And I remember I had my daughter with me there at the grocery store. And it was the first time I'd ever seen a developed country look like, and I didn't grow up around hurricanes where I grew up in the Midwest. It was more tornadoes. But it was unbelievable to me to see the fear and the anxiety ratcheted up to such a level that even I could not escape it. It was sort of like, wow, where is my bunker? Where can I go to shelter? Maybe that tornado hatch like they have in The Wizard of Oz, right? Kind of came to mind. Where's my billionaire bunker? I can go underground to seek safety. In fact, I'll tell you this other quick story too. I read in the New York Times in April or May, somewhere in there, that billionaires have been activating their end of the world safety bunkers. So in New Zealand, there's quite a few. And in fact, for some reason, Indiana has quite a few. And these are sort of underground, secluded bunkers where millionaires and billionaires go to seek safety if the world hit nuclear war, or in this case, a pandemic. So I guess the first thing I want to mention to your audience is, if you are a billionaire listening to Whitney's podcast, first of all, reach out to Whitney and work with him, because that would be awesome. But second, the world did not end. The world did not end. We are still here. And the reason why I bring this story up is we can only enjoy recovery if we are above ground. In other words, if we went underground with those billionaires and we're still there, we are not participating in the recovery. And so there are some strategies I want to get to, but first I want to mention what doesn't change. I think a lot of people, most of the people that I work with, are business owners who are trying to run their businesses profitably. They're landlords or they're passive investors who are wanting to run their investments smoothly. And it's a turbulent time right now. A lot of people are not paying rent, and they're even being given clearance by the government to not pay rent. And I think that trend, unfortunately, will continue. But what doesn't change is some of the ways we can protect ourselves and even antivirus our money going forward. So that's, I think, really where we need to go first is how do we pandemic proof our money? How do we become financially immune to the next recession, whether it's caused by a global pandemic or a housing crisis or a financial crisis like in 2008 or another tech bubble like in 2001? No matter the pin, there's always going to be bubbles. It's just sort of the underlying presumption. So that won't change. We've already had 3 major market corrections just since the year 2000, just since the start of this century. So what's to make us think that there won't be more in our lifetime? And I guess, do you want to have happen to you next time what happened to you this year? So that'd be a question I'd ask myself as a result of this episode. Now, here's some ideas for becoming financially immune. The first and foremost is you have to quarantine your money. You have to quarantine your money. Now, this is different than putting it in jail, okay? In jail would be products and strategies like 401ks and IRAs and CDs, money that needs to be paid a bail bond just to break it free. You know, a 401k, an IRA, a CD, other restricted investments usually require a 10% early withdrawal penalty just to get your money out of jail. Out of the account. So we call that a bail bond if we're talking about, breaking your money free from prison. So we need to get it out of prison, and we need to put that money in quarantine. And quarantine is very different. If your money is in quarantine, it's safe, it's accessible, it's liquid, and it has no restrictions or penalties to use that money for any reason. In fact, it's set apart from the financial pandemic that's going on in our country today. So if the markets are up or down, your money is growing at a competitive rate. That would be my very first thing. Does that spark any ideas or questions or comments?
Yeah,
Brittany,
for
in
sure.
terms of putting your money in a place where it's safe from volatility?
That's what we're all trying to accomplish, right? I haven't heard it said like that though, quarantining, our money. But it's good to think about what those restrictions are and the withdrawal penalty. I've not, heard it said like that. So that's such a good way to think about it. Well, where is your capital right now, and what is the penalty if you need it, 6 months from now, or a year from now, or next month. So that's great to keep in mind. So how do we, establish that putting our capital in that quarantine so it's readily available?
Right. Yes, exactly. Now, the next step in antivirusing your money is to ensure that it gets some sort of guaranteed annual growth to your cash, and that it grows on a consistent basis no matter what the market's doing. And that's really where quarantining that money, where it's going to uninterrupted compound grow for you for the rest of your life, is really just so important. And how many financial strategies give you that sort of predictable and competitive yield? I don't know too many, right? It's either whether it's real estate or the stock market or a CD or a savings account, they all have their benefits and they all have their drawbacks, right? So the next piece to being financially immune and to antivirus your money is to drink lots of liquids, So when you've got a financial flu, having lots of liquidity will provide for you a lot of pathways to becoming more healthy again. Just like when you're sick, you need to drink lots of fluids, need to be drinking lots of liquids. Well, similarly, with our money, we need to be putting that money in places that are still accessible to us and liquid and available to us. And what this often means is we sacrifice access for growth. And I think that's a non-choice, unfortunately. But too often we keep our money, we grab our money out of a real estate deal or sell our stock at the wrong time, and we lose value as a result. And we put that money Out of fear, we put that money into a liquid savings account or something similar, which earns 0 point nothing percent interest, but at least it's liquid. That's what we hear many people say. Well, there's some better alternatives than just a plain boring savings account that help us have access to the money where it grows in a competitive way. And we call this the bank on yourself concept. It's using a very modern form of dividend paying whole life insurance to allow for us to have competitive growth on our money. And it's still liquid and accessible. There's no bail bond to get the money out of your whole life policy. Now, in times like these, having an emergency fund or an opportunity fund for deals, which may be coming as the months and years progress, may just provide the kind of financial salve that can heal us financially anyway. I don't have a vaccine for the actual virus, guys. I'm sorry to disappoint us. But on the financial side of things, you could possibly find a true vaccine to the next financial virus that we all might go through if your money was predictable, accessible, guaranteed to grow for you, and had liquid access to it at any time. That to me spells as financial relief. It spells financial immunity from whatever the world or our economy throws at us. And so we can get into specifically how that fits into syndication deals and for passive investors, but also operators, if that would make sense for you, Whitney.
Please, I would love to know, or if you have an example, if it's the operator and he needs to put 50,000 or 100,000 into a deal, or if it's a passive investor and they're looking to put 50,000 or 100,000 into a deal, if you could give us an example of thinking through those sides of both sides of the coin there, and what that looks like with using the bank on yourself concept.
Sure. Well, and I'll give a very quick story and example. A gentleman just the other day, he had scheduled a 15-minute phone call with me just to say hello, get to know me a bit after hearing me on another podcast. And he had told me that he had received about $175,000 as a PPP loan from the government that recently came out. And he was just trying to figure out what to do with that cash. He had the choice to keep it in a savings account, but he wanted something better than just letting it sit there, soak, sour, and of course pay the payroll that he needed to pay, of course. But with the way his company was structured, he'd be able to keep that 175 on the balance sheet of his business. So, most people think that, hey, I've just got to let that money sit there in my savings account or dump that into a deal, a real estate deal. Well, what we talked about was we set up a dividend-paying whole life policy. We call it a bank on yourself type whole life policy. And he dumped in $175,000 into his policy. And he's been able since to borrow against that policy. Okay, so we can talk about how that works if you'd like, and use that to fund some of his operating expenses and some of his upgrades to some of the deals he's been working on. And to him, that's been better than just paying cash. And here's why. When you borrow against these policies, if it's designed the bank on yourself way, they'll continue to grow and earn dividends and interest as if you had not borrowed against the cash value. Now, to me, that is jaw-dropping. That is the ultimate fountain of youth for your money, so to speak. If we're talking about a vaccine against the problem of breaking compound growth, which is the ultimate devastator of our finances, right? Always breaking compound growth when we need to buy things, whether it's a cup of coffee or fixing up our kitchen or buying that new car or investing in some deal. Every time we spend money, it's no longer earning interest for us. The policy gives us a pathway around that problem. It gives us a bypass. It creates antibodies against the problem of breaking compound growth. And so this gentleman, he put the money, the $175,000, right into a policy. 30 days later, he borrowed a sizable chunk out. It was in the six figures. I think it was about $125,000 that he borrowed out and put it to work in his real estate. I think it was within about a month, he'd put the money in, and within 30 days, you can borrow the money right back out again for your deals or to pay off an old debt or to cover expenses if rent is not coming in like you hoped it would. You can use it to pay the payroll that the government requires of PPP loans. So it really comes down to what the operating needs of the business owner is. But the point is, yeah, he's able to put that money in, and within 30 days, that money's ready to be pulled out again for anything your business or your personal life might require.
Nice. Okay, so you put the money in, you can pull it out within 30 days, but that's in a loan. Is that correct?
Yes, there are two ways to get money out of one of these policies. You can do a traditional withdrawal, and I say traditional because it acts just like a normal bank withdrawal. Whenever I withdraw money out of a bank savings account, it's no longer earning interest at that savings account. It wasn't earning a lot of interest anyway. Let's be clear, right? But when I withdraw money out of a life insurance policy, it functions just like a bank savings withdrawal, no longer earning interest. Now, the second way to get money out of these policies is to borrow against the cash value. And that preposition there, that word against, is actually very important. So whenever I borrow against my cash value, I'm using my cash value as collateral. Case in point, let's say I've got $100,000 in cash value in my life insurance, and I want to borrow out $30,000 to buy a new car, or let's say to invest in some new real estate in my fund as a passive investor, let's say. So I take out $30,000 and I still get interest. And if the company's profitable, they'll throw dividends on top of that. So the interest and the dividends will be paid to me as if I had not taken that $30,000 loan. It'll pay me the guaranteed interest and the dividends on the entire $100,000, even on the 30 grand that I had borrowed out. To me, that's pretty remarkable. And I'll just mention this quickly. There is no required repayment plan on these loans. So you can borrow the money out. Let's say that you're an operator and you want to borrow the money against your policy and put it to work in some of your deals. And maybe you need to wait 3 years before you have a liquidity event and you sold one of your funds and you walk away. You could let that loan grow over a 3-year period. With the insurance company won't call you. They won't ding your credit. They won't report it on third-party, credit rating agencies. It's a private loan between you and the insurance company. If you should pass away during that 3-year period, your family, would get the entire death benefit minus the loan paid out to them income tax-free. And of course, once you do pay the loan off, you've got the cash value growing on the full value. So you did not hurt your retirement fund or your cash value growth fund, even though you'd borrowed against the policy for the last 3 years.
You mentioned you said something about if the business is successful or if they're going to pay out dividends. Which business is that exactly? Is that something that that's holding the money, or how do we ensure that happens?
Yeah, right. So I would again really recommend your audience look into this further, because there are about 1,100 life insurance companies in the United States, and not all of them are worth doing business with. In fact, most of them, I would not recommend your audience listen to or work with just any insurance agent or have a contract with any insurance company. You want to work with insurance companies that are mutually owned and have been around for a good century or more, because I really want to see how they've performed during tough times. Like, I want to know how they did during the last pandemic of 1918. In fact, the companies that I would recommend, which is where these dividends would be paid out from, would have been paying out dividends and were paying out dividends straight through the last century, including the Great Depression, including the Spanish flu of 1918, and most recently 2008, and now even 2020. They've all announced dividends paid out, consistent dividends paid out even this year. Now, dividends are not guaranteed by the insurance company that you have a contract with. But like I say, I would really work with companies that have been around for at least 100 years and haven't missed a dividend in that last century.
Is that something that we're going to ask somebody like yourself? Like, where are we going to get that information?
Yeah. So you can try to piece all this together. You can build your own bridge if you want to. You can build your own iPhone if you want to. I can't. Or you can work with a competent professional who's been through all of this and has learned all of this and understands how best to structure these policies and which company to work with and how to arrange the policy in the most efficient way so it minimizes commissions and it minimizes the insurance expense. And yeah, the best way to do that, in my personal opinion, is to work with a bank on yourself professional who's gone through those rigorous training requirements. It took me about 3.5 years to really become competent in this strategy and to receive that certification. And it's the only one in the industry I'm aware of. Everybody else is kind of a, hey, I read about that once type advisor. There's a lot of nicknames for this out there. I don't have time to mention them all, but if you want to work with the equivalent of the USDA organic version of this in your marketplace, look for bank on yourself professionals, or just reach out to me. I'd be happy to connect you with one of them.
Nice. Okay, so we've put our money, we've put that 50 or 100,000, or you can even use the same example you were using earlier of the 175,000, either one. But I guess I'm just trying to make sure, like, the listener and myself understand what happens with that money. So, we're putting it in there. When do we, can we ever stop this? I guess I want to ask that before I forget. Can we ever stop it? Does it ever, if we just said, okay, Mark, I just don't really like this anymore. I just want to have the capital in the bank. I've changed my mind. Is that an option?
Right. Yeah. Well, I'll give another quick story. We had someone just yesterday call me. We had set up a 15-minute call and we scheduled it. He was on his way from Illinois to Colorado and he was driving, of all things. He used to be an airplane, fanatic, but he was driving because of the changes in our world's culture these days with relation to airplanes. And so he had plenty of time to listen to our podcast, which is cool. So he was listening to some of our shows, asked me the same question. He had a good chunk of cash and he was curious, hey, how long do I have to fund this? The answer to your question is, yeah, you could simply put a lump sum into one of these policies as a single premium, one-time payment. There's no ongoing contribution or requirement to fund it. It's one and done. And then it just kind of sits there and cooks and grows over the rest of your life on a guaranteed basis with dividends on top of the guarantees if the company is profitable. So that's one way to do it. I've had other people who recently, as a result of the CARES Act, call me up and say, hey, Mark, I've got eligibility to take $100,000 out of my 401k and I won't be penalized for it. Here's one way to get the money out without a bail bond, Whitney. This year, the CARES Act allows us to take up to $100,000 out of our tax-deferred 401k, our tax-deferred IRA. Even if you're younger than 59 and a half, you can get access to up to $100,000 out of these qualified plans, take them out without an early withdrawal penalty. And Congress is letting us spread our tax payment out ratably over a 3-year period. Now that is huge. Tell me any other time in our history where the government has said, hey, you don't have to pay us your taxes this year. We'll give you 3 years to pay it. That's awesome. So a lot of our clients and folks have been calling us to move money in from their 401k and IRA to do that lump sum I just mentioned, or to spread it in over a few years. So I've got clients that have put money in as one payment, as mentioned. People who are putting it in over 3-5 years. Others that are putting profits and proceeds from their rent money or their passive income or their acquisition and liquidation deals on their syndication projects, and they're moving it in over a long period of time. So it really can be funded various number of different ways. Did that answer your question? It almost is too flexible. You can really design this any way you choose.
Can they end it at some time if they just said, Mark, I don't like this anymore. I just want to have the money in my bank account. Yeah. I'm just more comfortable with that.
Yeah, thank you. So if they've got a tough time that they're going through, they can cash out and walk away from the policy. They just get a check in the mail for their cash value, and the insurance contract is complete. Walks away from the policy, keeps the cash. The cash value is theirs to walk away with anytime they want. Or they can borrow the money out and never pay it back, and it's just their cash in their bank account, but they keep a little bit of money in the policy to leave as a sort of a reserve amount so that the death benefit still pays their family when they pass away. That's just 2 ways you can just walk away from the deal if you decide you don't like it anymore.
What are the cons? What's the worst thing about doing this?
Yeah, you don't want to do this with any advisor. We've already mentioned that, or any insurance company. I'd say a lot of the downsides to this is just knowing that you've got the correct design. I've seen too many people thought they had one of these in their portfolio, and they were still stuck in the Wall Street casino with a variable universal life policy or an indexed universal life policy. Those are kissing cousins to what we're describing today, which is a dividend paying whole life, but they are very different in terms of who shoulders the risk. And again, the things that are changing in our world with the amount of risk on our shoulders as business owners, as real estate investors, there's no reason why we unnecessarily have to add that risk to our shoulders when we've got so much other turbulence going on in our world. I would also say don't do this if you need instant access to 100% of your capital this year. Because when you put money into one of these policies, you're going to lose some of your purchasing power due to the cost of insurance. Even a well-designed, efficient policy has insurance expenses. There's no way to get around that. Depends on how the policy is designed to really pinpoint exactly what those expenses are. And we do a 15-minute phone call discussion to sort of get into some of those expectations, Whitney, just so your audience knows that. We can sort of see what their needs are, to see if it's even a good fit, and before we make any recommendations.
Nice. So, I guess give us, just highlight a few of the big pros of doing this as well before we have to move to just a few final questions.
Sure. Yeah. I think we've laid the case, I believe, for what's changing in our world today, which fundamentally, I don't think we'll ever go back to the world that was in 2019. But there's a lot that hasn't changed. Our need for liquidity. We need liquid access to capital for our emergencies, for our opportunities. We need assets on the balance sheet to help build a productive and profitable real estate business. We need the ability to compound and grow our money in ways that are safe and competitive and predictable. Those things, I think, are set into the bank on yourself paradigm. And banking, I think, doesn't change. We always need the banking function in our world. The only problem, and I think the change that we can make, the only problem is we're sitting on the wrong side of the banker's desk. And if we can make that shift, if we can move to the right side of the banker's desk, where we can become our own source of financing, we can be financially immune to anything else the world throws at us.
Nice. Okay, Mark, anything else about this concept that you specifically want to ensure the listener knows about before we move on?
Yeah, I think it helps you, speaking of financially immune and becoming pandemic proofed, it helps you breathe. It's what I call the swan money, or sleep well at night money. And if you can breathe, if you've got that cushion. I had a conversation with a young couple yesterday. They're doing some mobile home park investing. They've got a syndication deal they're working in, and they have their policies packed in with enough cash that they said they can finally breathe. And with everything going on with the pandemic and how it impacts specifically our lungs, and my heart and my prayer goes out to everybody affected by this virus. But I think a metaphor for that is where does your money need to live so you can breathe? So I'd say that's one final thought about this strategy in the midst of these uncertain times.
I meant to ask you also about the risk of losing all the money after you put it in there. I mean, what's the chance or the risk, the option, or, how could that happen? When would that happen? Has it ever happened?
Yeah. Well, I'll give a quick story to this. So there is a guarantee that your cash is your cash. You can walk away from the policy and it's guaranteed that you'll get the cash surrender value. And the insurance company cannot just renege on that contract. It is a unilateral contract. What that means is, even if the insurance company got into trouble, let's say that they went through bankruptcy, first of all, I wouldn't have recommended a company that tight on their margins. If it were me, I would be making sure that these were companies that were financially solvent and would be there for the next 100 years. But you never know, right? There's a guarantee, but you never know. This side of heaven, nothing's guaranteed. So if the insurance company went through bankruptcy, there's a process in your state, the state Department of Insurance and the insurance commissioner where you live would take over the insurance company that was bankrupt in your interest. And typically he or she, the insurance commissioner, would reallocate those policies to new, more solvent insurance companies. And the new insurance company would uphold the promise to pay and the guaranteed cash accumulation. So essentially, the policyholder who had this happen to him or her would just see the change of logo on the top of his or her annual statements from the contract's cash value growing every year. Just be a change in company name is the upshot of what would happen. So in 2008, there were almost 500 entire banks, Whitney, that went bankrupt in 2008. 500 whole banks. In that same year, one insurance company went bankrupt, and it was a small little company in Texas. I think it was called Lincoln Memorial Life Insurance, and I didn't work with them. I didn't know much. I was just researching this, and what happened was the Department of Insurance in Texas gave all the policies to another company that ran those contracts and continued to pay the policyholders their guaranteed cash accumulation.
Wow. All right, Mark, I appreciate you elaborating on that and giving us many stories to help us think through and hear examples to better understand this method. I've heard more about it, in the last probably 2 months, and before that, I've never heard hardly anything about this method. And so it's great to hear more examples and the studies that you've done. But a few final questions. What's a way you've recently improved your business, Mark, that we could apply to our business?
Yeah, I'd say really sitting down and, one of my favorite things is project planning. I never thought I'd say that. I guess I must be an adult now. So look up Gantt charts. That's been a lot of fun to just sort of organize my thoughts in a structured way that sort of says, here comes the first thing, the second thing, the third thing. You can use Trello or Microsoft Project, just a neat little tool to help improve your company and your personal life.
Nice. Love things like that help us to get more organized. What about the number one thing that's contributed to your success?
Yeah. Number one thing, I'd say reading has been a big one. And I've been reading a book, see if I can grab it real quick, on Audible. It's called Breath. And it got me thinking about our financial life and that point about breathing earlier that I mentioned. The book is Breath by James Nestor. It's called The New Science of a Lost Art. Breath. Great book. And I'd say it's contributed to my success because I don't snore as well, or don't snore as much at night, and my wife is happy for it.
Love that. How do you like to give back?
I'd say the best thing you can do is mentor people who are absolutely focused on seeing their own success and seeing that little spark in their eye when they catch the idea of whatever it is that we're talking about. It's just so rewarding, and it gives me the emphasis, the desire, the motivation to keep going.
Nice, Mark. Well, I'm grateful for your time again and just sharing this method more in depth with us today and just helping us to think about, what did you call it? Proofing our pandemic, proofing our money or something like that. I'm just grateful for any kind of thoughts or any kind of methods like that are new to us. I know a lot of the listeners haven't probably heard of that before. So I hope that they will reach out to you and get a better understanding of this and if it's a good option for them. So how can they do that, Mark? How can they get in touch with you and learn more about you?
Guys, if you want to have that 15-minute intro call, we just sort of chat, hear if this is a good fit for you or not, you can go to growmorewealth.com. That's growmorewealth.com. And if you'd like to dive a little deeper, if you're on that 16-hour road trip like that gentleman earlier, you can check us out at Not Your Average Financial Podcast. And we're binge-worthy, or at least we try to be, as often as we can.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.